Wall Street wants you to believe that successful investing has to be complicated. They want you to think it requires a dizzying array of mutual funds, a complex tapestry of international stocks and corporate bonds, and a team of expensive advisors to make sense of it all. They profit from complexity. They thrive on the idea that you, the individual investor, can't possibly navigate the markets without their sophisticated and often costly guidance. But what if that's not true? What if the most powerful, effective, and reliable strategy for building life-changing wealth over the long term wasn't complex at all? What if it was simple? So simple, in fact, that it could be accomplished with a single purchase. That's the question we're going to answer today. We are going on a definitive, data-driven quest to find the one fund to rule them all. If you could only buy one single ETF for the rest of your life, a true set-it-and-forget-it investment, what would it be? Stick around, because by the end of this video, you will have a clear, unambiguous, and powerfully simple answer. The modern world presents us with a paradox of choice. There are now more ETFs in the United States than there are individual stocks listed on the New York Stock Exchange. This explosion of options meant to empower investors has instead led to analysis paralysis for many. The core objective gets lost in the noise. And what is that objective? For the long-term passive investor, the goal is not to chase fleeting trends or try to outsmart the market. The goal is to harness the single greatest wealth creation engine in the history of the world, the American economy. We want to do this in the most efficient, diversified, and cost-effective way possible. To find our one perfect fund, we need to establish a set of non-negotiable rules. This isn't about picking a favorite or chasing last year's winner. This is a methodical search for the objectively best vehicle for a single fund portfolio. Our champion must meet 4 strict criteria. First, maximum diversification. Since this will be our only holding, it must provide the broadest possible exposure to the US stock market. It cannot make concentrated bets on a specific industry, company size, or investment style. It must own the entire haystack, not just a few promising needles. Second, an ultra-low expense ratio. Fees are a cancer on your returns. They are a guaranteed relentless drag on the power of compounding. Our chosen fund must have costs so low they are practically a rounding error. Third, market representative returns. The fund's purpose is to mirror the trajectory of the US economy. It shouldn't be designed to dramatically outperform or underperform the market, but to be the market. And fourth, a purely passive management style. There will be no star fund manager making brilliant bets. The fund must be built on a simple, transparent, rules-based index that automatically adjusts to the ever-changing landscape of the American economy. Our first contender, VOO, is arguably the most famous index fund on the planet. Its strategy is simple and powerful. It tracks the S&P 500 index, giving you ownership in 500 of America's largest, most profitable blue-chip companies. When you buy VOO, you're buying a piece of Apple, Microsoft, Amazon, and hundreds of other corporate titans that define the modern economy. Let's look at the numbers. VOO's scorecard is undeniably impressive. It boasts a microscopic expense ratio of just 0.03%. That's just $3 in fees for every $10,000 you invest. It has delivered a compound annual growth rate of over 15.2% over the last decade, turning a hypothetical $10,000 investment into more than $41,000. It is, by all accounts, a fantastic investment vehicle. So what's the verdict? For a multi-fund portfolio, VOO is an exceptional core holding. It's cheap, it's reliable, and it gives you a direct stake in the biggest players. But for an investor who can only own one fund, VOO has a critical and often overlooked flaw. The S&P 500, despite its name, does not represent the entire market. Those 500 companies, while massive, only account for about 80% of the total US stock market's value. By owning only VOO, you are intentionally excluding thousands of small and mid-sized companies, the potential giants of tomorrow. For a single fund portfolio, this omission of 20% of the market is an unnecessary and avoidable risk. VOO is a champion, but its reach is incomplete. Next up is the fan favorite of income investors, SCHD, the Schwab US Dividend Equity ETF. SCHD's strategy is more refined than simply tracking an index. It follows a rules-based system to find the best of the best. It screens for about 100 US companies that not only pay dividends, but have a long history of doing so, possess strong financial health, and have high return on equity. This is not a high-yield fund in the risky sense. It is a high-quality fund. By the numbers, SCHD is very appealing. Its expense ratio is a low 0.06%, and it currently offers a dividend yield around 3.8%, significantly higher than the broader market. This focus on quality and value has led to strong performance, often with less volatility than the S&P 500. The verdict? SCHD is a brilliantly constructed ETF. It is a fantastic tool for generating a growing stream of income within a larger, diversified portfolio. However, as a sole holding, it falls short of our criteria. With only about 100 stocks, it is far from being maximally diversified. It is an active bet on a specific factor, in this case, value and dividend-paying stocks. While that's a great factor to bet on, it deviates from the passive ideal of owning the entire market. If dividend stocks go out of favor for a decade, your entire portfolio will suffer. SCHD is a specialist, not a generalist, and for a one-fund solution, we need a generalist. Now for our third contender, the personification of high-risk, high-reward, QQQM. This fund tracks the NASDAQ 100 index, which is comprised of the 100 largest non-financial companies listed on the NASDAQ stock exchange. In simple terms, this is a concentrated bet on technology and innovation. Think Apple, Microsoft, Nvidia, and Tesla. The numbers here are staggering. The NASDAQ 100 has produced phenomenal returns, with its proxy fund QQQ delivering a compound annual growth rate of nearly 20% over the last decade. A $10,000 investment would have ballooned to over $60,000. However, this performance comes at a cost. QQQM's expense ratio is 0.15%, 5 times higher than VOO, and its concentration is extreme. The top 10 holdings make up nearly 52% of the entire fund. Our verdict on QQQM is clear. Its historical performance is a masterclass in recency bias. The psychological trap of assuming recent trends will continue indefinitely. While it has been an incredible investment, holding only QQQM is not passive investing. It is active speculation on a single sector of the economy. The concentration risk is unacceptably high for a sole holding. It violates our core principle of maximum diversification in the most dramatic way possible. QQQM is a rocket ship, but for a one-fund portfolio, we're looking for an aircraft carrier. Our fourth contender, DGRO, often gets compared to SCHD, but it plays a slightly different game. The iShares Core Dividend Growth ETF focuses on companies with a proven history of growing their dividends consistently for at least 5 years. Its goal is a reliable, growing income stream, not necessarily the highest yield today. Looking at the numbers, DGRO is more diversified than SCHD with around 400 holdings. Its expense ratio is a respectable 0.08%. Its portfolio is more balanced across different sectors than SCHD or QQQM. It's a solid, well-rounded fund that prioritizes financial health and shareholder returns. So what's the verdict? DGRO is an excellent fund and arguably a more balanced choice than SCHD for a core holding. But like SCHD, it fails the one-fund test for a simple reason. It intentionally excludes a huge part of the market. Any company that does not pay a dividend, no matter how successful or fast-growing, is left out. This includes giants like Amazon and Alphabet and thousands of smaller growth companies reinvesting their profits for future expansion. It's a fantastic fund, but it's an incomplete proxy for the American economy. This brings us to our final contender, VTI, the Vanguard Total Stock Market ETF. VTI's strategy is the purest expression of passive investing. It doesn't try to pick winners. It doesn't focus on a specific size, sector, or factor. Its mission is to buy the entire haystack. VTI tracks an index that includes nearly 100% of the investable U.S. stock market. The numbers tell a story of unparalleled scope. VTI holds over 3,500 different stocks, from the largest megacorporation down to the smallest microcap. If it's a publicly traded U.S. company, it's likely in VTI, and it delivers this incredible diversification for the same rock-bottom expense ratio as VOO, just 0.03%. The verdict? VTI embodies the essence of our search. It is the ultimate generalist. By owning VTI, you eliminate the risk of missing out on the next big thing because you already own it. You eliminate the risk of choosing the wrong market segment, large caps, small caps, value, or growth, because you own all of them. A common question is why VTI's performance is so similar to VOO's. The answer is that the fund is market cap weighted, so the 500 giants in VOO do drive the majority of returns. But choosing VTI isn't about chasing higher returns. It is a superior risk management decision. You are immunizing your portfolio against the possibility that the next 20 years of growth come from outside the S&P 500. Now, for the final showdown. Let's put our contenders side by side on the metrics that matter most for a one-fund portfolio. First, the diversification spectrum. This is the most important factor. SCHD and QQQM give you about 100 stocks, DGRO 400 stocks, and VOO gives you 500. VTI gives you over 3,500. For a single holding, the case is closed. VTI's diversification is in a league of its own. Next, the corrosive power of costs. Let's run a simple scenario. Imagine you invest $100,000 for 30 years and earn an average 10% annual return. With VTI's 0.03% expense ratio, your final balance would be over $1.74 million. With QQQM's 0.15% expense ratio, your balance would be just over $1.70 million. That seemingly tiny 0.12% difference in fees cost you over $40,000. Over a lifetime of investing, costs are monumental. Finally, the shifting tides of the market. Market leadership is cyclical. The tech giants that dominate QQQM today may not be the leaders in 2040. The value stocks in SCHD might underperform for a decade, just as they did in the 2010s. Betting on a specific factor or sector is a gamble. Owning the total market through VTI is a guarantee. It guarantees you will always hold the winners, whoever they may be, automatically adjusting your holdings as companies rise and fall. So, here is your fortune cookie, the one simple truth to take away from our entire journey today. The goal of a one-fund strategy is to trade the stressful, often fruitless quest for market-beating returns for the peaceful certainty of achieving the market's return. It's an admission that the simplest solution is often the most powerful. Betting on a single company is a gamble. Betting on a single sector is speculation. But betting on the combined ingenuity, innovation, and relentless drive of the entire American economy isn't a bet at all. It's the most sensible investment you can make. With VTI, you do exactly that, and you let the unstoppable power of compounding do the heavy lifting for you for decades to come.